So, what is technical analysis? In short, technical analysis is the study of price through the use of charts. The price action or market action, the two phrases are interchangeable, refer to the price movements of a market and the related volume. So, how does technical analysis differ from fundamental analysis? Well, while a technician will concentrate their efforts on studying the price action, a person applying fundamental analysis will focus on reading the economic data. In the context of futures trading, important factors that an analyst considers are gross domestic product, inflation, the US dollar, and even weather patterns. What is a price? The primary task of a chartist is to analyze the strength or the weakness of an asset price, such as a commodity, bond, currency, equity index, etc. Please note that finding the reason for a shift in supply or demand comes as a secondary task. A bar chart is one of the most commonly used types of chart. The bar chart displays a price range for a given time period, and it shows the open, high, low, and closing prices. It's also known as OHLC. The vertical bar represents the daily range of the price. The wider the range, the more volatility there is in the market. The left tick on the bar represents the opening price, the right tick represents the closing price. In this example, the E-mini S&P 500, the close is higher than the open for that day. This is considered bullish. For many chartists, the most important piece of information will be the closing price for the day. There is a saying on the street, amateurs open the market, professionals close it. Another popular chart view is the candlestick. A candlestick differs from the display of the price bar we looked at previously. In this example, the thin line referred to as the shadow shows the day's price range from the highest price to the lowest. The candlestick body, the thicker part of the line, measures the distance between the open and the close. If the close is higher than the open, what is referred to as a bullish pattern, then the body will be displayed in green. In this example, the price of gold futures has descended during the day and closed near the low point. This is an example of a bearish candlestick, as it shows that the market price descended during the trading day. Bearish candlesticks will be colored in red on most charts. We'll discuss candlestick patterns and their meaning in a later module. Combining price and volume in futures trading could provide some important information for a trader. Volume, by definition, represents the total trading activity in a given time period. A long bar indicates heavier volume, more trades being made, while a short bar represents lighter trading activity. In this example, price is ascending, supported by increasing volume. This is a bullish pattern as it shows conviction on the part of the buyers involved. Conversely, if price rises on a light volume, generally speaking, we cannot expect it to go far. It's like going on a round trip on an empty fuel tank. By definition, open interest is the number of contracts or commitments in the futures market that are trading on an exchange at any one time. In the early stages of a contract's life, both the volume and the open interest are fairly low. Towards the end of a contract's life, the volume typically increases. Let's look at the previous chart again. We can see that volume is moving up in the last stages of this oil futures October 16 chart. And the build-up typically takes place as the contract approaches maturity. Comparing the volume versus the open interest is always good practice when confirming liquidity in a product. Let's quickly review what you've learned. Technical analysis allows futures traders to assess the market action. Among the most popular tools are the price bar and candlestick. Volume and open interest also play an important role as they tell us which futures contracts are most liquid. As a rule of thumb, trading activity should be limited to months with the highest open interest.